So Ibrahima, do you send us the recording or how do we?
Yes, I sent you the link already. So
okay.
It's a permanent link. I'm gonna add tonight's sessions at the end of the course today.
Okay.
Yeah, so the same link, you could use it and you'll have access to them.
Okay.
So you may start if you are ready, Alec.
Yes, indeed. So good evening, ladies and gentlemen. I'm Alec from Denver, and I will speak separately from Earl this afternoon and evening, and mostly it's Earl that's going to be speaking and having slides. So for myself, I'll just make some preliminary remarks. So one thing is that I read over all of the things that were on chat, and I wanted to just respond in general to start with. And here are the things that I chose to respond to, mostly everything. From Ed Dodson, I don't know if he is here with us today. The question, the note that he had is, one issue deserving discussion is that the existence of BND, Boulder, so the Bank of North Dakota, has not prevented the same or nearly the same credited fuel and speculation-driven increase in property prices. Yes, I think that that's a very important piece, that it's not as if any public bank is going to behave in ways that are always in favor of the common good. It matters a great deal how the bank is governed and what it does with its powers. And that depends very much on, one, on the charter that details essentially what it can and cannot do, and secondly, on the board of directors that has to follow what the charter has to say. So we are very, very keen, once we get a public bank or public banks in Colorado, to see to it that they're not influenced either by political or corporate forces, because it would undermine its reason for being, and that is to serve the public good. So that was one piece. The second one is that Scott Baker said that public banks will have to be cooperated with or complemented with a land value tax, because otherwise you can get a great deal of this land speculation piece again. And I tend to agree with that view. When both Earl and I think very, very strongly that public banks is not a panacea, that a number of other things need to come together, but it's, even though it's not a panacea, it's, we believe, a necessity. And the third piece, so we're very conscious of the fact that a public bank needs to be complemented with other kinds of movements, and land value tax is one of them. And the third one is from Thomas Greco, having to do with the idea of, when I was talking about modern monetary theory, Thomas Greco suggested strongly that we need to have local authority. And we also agree with that notion. That's why we are suggesting public banks, both in terms of state banks, but also municipal banks or city banks. So that's, I think, what I have to say about the notes that were sent, and we didn't answer as they came in. The second topic is with respect to something that economists write in their textbooks and also teach in all of the economic departments when it comes to one chapter about money, which they call money and banking, and which I taught for very many years, not very well. And that is that when they want to define what money is, they don't define what money is, they just talk about the functions. And the three functions, as some of you might remember from your college days, is that money is a medium of exchange, a unit of account, and a store of value. That those are the functions of money. Now, modern monetary theory has put a lot of emphasis on money as a unit of account. And most bankers and economists put a great deal of emphasis of money as a medium of exchange. But the MMT people argue that looking at the historical record, there is no evidence that money emerged as money as a medium of exchange, or Robinson Crusoe exchanging with somebody else. All of that is essentially a myth in the bad sense of the myth, that it is came out as a unit of account initially in Babylonian times and Sumer in the Middle East, and also in Egypt from historical records. What we're saying with public banking is what we don't care how money is defined. What we care about mostly is who produces it and for what purpose. So that's the principal idea that we want to time and again underline. One third thing that I want to add before I hand it over to Earl. As some of you know, I'm a Greek national, although become an American citizen. I was born in Alexandria, Egypt, and but lived quite a bit of my life in Greece. And since 2015, I've been following the ideas and the actions of the former Greek minister of finance minister, Yanis Varoufakis. And one of the things that he says that strike me, he says lots of things that I agree with actually, is that we've got to be very careful in the left spectrum of the political arena that we don't quarrel, that if we differ, that we bring up those differences so that we can really say not so much we're of the left or the right or Republicans or Democrats or Labor or conservative, but what we are in favor of and on what grounds, philosophical or spiritual or humanistic, are we in favor for such goals, let's say, to achieve our goals through democratic means rather than through autocracy, to do things non-violently rather than through violence or war. And so therefore we can have an agreement as to what it is that we want to achieve, what policies we recommend, and something that I find we find increasingly in Colorado and in our group of Rocky Mountain Public Banking Institute is once you've decided on goals and policies, the third item that we've not yet been successful in doing is how do you pass the legislation that will produce the policies that will achieve the goals? This is extremely, extremely important. And it's something that by and large universities rarely ever do. They just talk amongst themselves about what is the right theory or what are the mistakes of the other person's theory, etc. And we rarely come to a conclusion, and then also how to politically put those conclusions into action. So this is the thing that for us is, remains to be done. And so this is what we're going to attempt to do this year, because all the other years when we've attempted to get public banking into legislation for Colorado, we have not yet succeeded in getting even one legislator to agree to sponsor the legislation. So with that, I will hand you over to Earl, who is going to use his very good slides to show you the work of a particular economist. So go ahead, Earl.
Okay. I need to share my screen. This is a quote from Reed Simpson, a former Wall Street banker, and it's actually from the foreword to Ellen Brown's book, Web of Debt, which was written now 15 years ago in 2007. Here's what he says. I've been a banker for most of my career, and I can report that even most bankers are not aware of what goes on behind closed doors at the top of their field. The process by which money comes into existence is thoroughly misunderstood, and for good reason. It has been the focus of a highly sophisticated and long-term disinformation campaign that permeates academia, media, and publishing. The complexity of the subject has been intentionally exploited to keep its mysteries hidden. And he also quotes Henry Ford, and I'm sure a number of you have heard this quote, but Henry Ford said, "It is well that the people of the nation do not understand our banking and financial system. For if they did, there would be a revolution by morning." So the question is exactly how do banks create money? The International Review of Financial Analysis in 2014 published an article by Richard Werner, an Oxford-trained economist who I'm sure many have heard of. The title of the article was, "How do banks create money and why can other firms not do the same? An explanation for the coexistence of lending and deposit taking." This is a remarkable article because it really spelled out for the first time how banks do the accounting for new loans. And it's one of the proofs of the fact that banks create new loans, create new money when they make a loan. So let's look at that. This is a key part of his article. What does a bank do compared to other lenders? For example, a corporation, a stockbroker, that gets a deposit, corporation that lends money, or perhaps a shadow bank that's not a real bank. A real bank, on its balance sheet, when it makes a loan, treats the new loan as a new asset. So you see their new loan, $1,000. That's a new asset. And it also, in its liability column, has a new deposit. And that's quite a remarkable difference from other types of lenders. The new deposit is a new asset of the borrower. And then once that loan is complete, the borrower then has this new deposit in the bank that he can take out when he wants to. Now, the bank actually has to come up with the cash, with the money. So they have to account for that as well. They can actually borrow it from their deposits, but if they do, they owe it back. The loan does not actually come out of the deposit. Or they can borrow the money from other sources, including the Fed, or they can take it out of their cash. But they do have to provide to the borrower the actual money. So how does another type of lender that is not a bank account for the loan? Well, you see the new loan, just as with a bank, is a new asset. The bank is owed $1,000. But the other lender cannot record it as a new asset. It must take the money out of its cash or otherwise create the money. It does not add to the money supply. Whereas by creating a new deposit in the bank in the name of the borrower, that money is treated by the Federal Reserve and the entire monetary system as new money. And so you actually have the bank able to create a new asset of $1,000 or $20 million, and it then has the right to collect the interest on that $20 million, let's say. That's a tremendous capability. And of course, it makes a difference, as we discussed in our last session, whether that's a private ability that private banks can use for their own profit, or it's under public control, which we contend is extremely important, so that money can be used to benefit the public interest rather than private interest at the expense of the public interest. A very important point that Werner makes in his article is that there are actually no laws that actually permit banks to create money out of nothing. There's no law or bank regulation that declares that it's legal for a bank to create money out of nothing. On the other hand, there's no law that makes it illegal. So banks have been able to do this generally without the knowledge of the general public. Werner did a little informal survey asking the question of people, who do you think creates most of our money? And as I think most of you know, the answer of most people is they think the government creates our money. But the truth is that private banks in this country create 97% of the money in our economy. And that's true in Europe, it's true in Great Britain. Of course, it's not true. It's not true of a public bank in the sense that it's publicly created, but it is banks that create 97% of our money. Whoop. All right. All right. Werner wrote an article also in the International Review of Financial Analysis, which is online. This is a much longer article, 19 pages long, entitled, "Can Banks Individually Create Money Out of Nothing? The Theories and the Empirical Evidence." At the time, he was with the University of Southampton, their Center for Banking, Finance, and Sustainable Development. He's now with Linacre University at the University of Oxford. And at that university, it's a graduate school only. There are about 550 students. There's an emphasis on sustainable development. And it's a very publicly interest-oriented university or college as part of Oxford University. So in this article, which I recommend everybody read, you can look it up and read it. It's also in PDF that you can download. He conducted the first ever empirical test of how banks create money. And it was to test which of three theories is correct. Whether they create money out of nothing when they make a loan, whether it's the fractional reserve theory where banks collectively create new money in succession after a new deposit is made and they lend out a portion of deposits and retain a portion of it, or is it the financial intermediation theory where banks lend out their deposits? He conducted this test at a small community bank in Germany. He tried to do it at a large bank, but wasn't able to get sufficient cooperation. In the test, he did a $200,000 euro loan to himself. He interviewed the bankers. There were several people involved in the loan, not a large number, but they had to actually take the steps to initiate and complete the loan. He interviewed the bankers, and he actually videotaped not only their verbal actions, but also the books of the bank. And he showed the records and how they were affected through their bookkeeping. And the conclusion was very clear. The bank's assets and its liabilities increased by 200,000 euros. Therefore, the money was newly created. It's rather interesting that although this new creation of money has existed for hundreds of years, this is the first time anyone ever made an empirical test of it. And I think that's greatly to Werner's credit. He still wanted to be even more definitive, and he published another article a year or two later, also in the International Review of Financial Analysis, where he made it even more definitive because the bank had many, many transactions that day, and it had, like banks generally, a very substantial balance sheet of assets and liabilities. It made it a little harder to sort out, exactly where the new money is created. So what he did was he withheld the transaction and reported it after the year was over so that it was separately recorded, independent of all the other transactions for the year. And when he did that, it again became even more clear that he had created new money out of nothing on the bank's books. The next theory of the three theories is the fractional reserve theory, that banks collectively create credit by lending. Thus, if banks have a 20% reserve requirement, where if they get a deposit, they have deposits, they can only lend out, they have to retain 20% of that in reserve. By that method, by lending out a portion of that money, as each other bank receives deposits and retains a portion of it, eventually with a 20% reserve requirement, you can get a multiple of 5 times the amount of the new deposit. This theory was first described in detail actually in 1888 by a guy named Marshall. It didn't really take hold until about 1930, when it became quite popularized by a guy named Philip. And that theory prevailed from about the 1930s to the 1960s. Going back a step, the first person to really document the money creation theory was a professor of banking and finance in Great Britain, MacLeod. And MacLeod wrote a textbook, a 2-volume textbook on banking that was widely used and published in over 6 or more editions over a period of 55 years, from 1855 until something like 1909. And he was a good writer. He was clear, and that had a lot of influence. One of his followers was Schumpeter, who was at Harvard. And in 1924, Keynes himself endorsed the money out of nothing theory. Other bankers and economists actually endorsed that theory at times too. But what's especially remarkable about these theory of banking, besides the fact that they're mutually exclusive, is that we have some economists and experts who at different times endorse all 3 of the theories. Considering that they're mutually exclusive, what kind of scholarship does that indicate is actually being exercised on this important subject? It would certainly be troubling if mathematicians believed that 2 + 2 was 4, and they also believed that 2 + 2 was 5, and that 2 + 2 was 7. But that's essentially what has happened with economics, that you have these 3 theories and you have leading experts. Samuelson's another one that at different times in his textbook endorsed all 3 of the theories, but mostly he's endorsed the latter 2, including the fractional reserve theory. The final theory is the intermediation theory, and this is the idea that banks lend out their deposits. This theory has actually been dominant for the last 60 years or so. Keynes also endorsed this theory, as well as the other 2. So did Samuelson. Tobin, who won the Nobel Prize in economics, endorsed this theory. Stiglitz, who's one of the more progressive economists and also won the Nobel Prize, all endorsed this theory that banks lend out their deposits. Another point that Werner makes that's very important is this theory has very important implications for regulation. He makes the point that if banks do create money out of thin air, as he proves both through the accounting that is widely accepted by banks and through his empirical tests, then capital adequacy regulations that are in use now by the Fed and the Bank for International Settlements will not work. And the reason for that is that banks can create new money out of nothing and use that to create new capital. If they can use that to create new capital, they can then increase their lending within the capital adequacy rules and still expand endlessly. So that's a serious, very serious issue. And he points out the example of the Credit Suisse who did that, and also Barclays did that. It's an incredible fact that that's the case. And finally, I want to mention, and this is implied in that original quote from Reed Simpson about the fact that the real truth of how banks create money is really hidden from the public. And many bankers don't even know it, and how it's the actual way that banks do create money. Keynes, despite having endorsed the creation of money out of nothing theory in 1924, not too many years later, ridiculed it, calling people who believed in that theory crackpots. Tobin ridicules it. He used the term people who think you can create money out of nothing. It's like the widow's cruse, which is a device that can be used to create things out of nothing, create wealth, among other things. Another point that Werner makes is that the Reichsbank, I'm not sure I'm pronouncing that correctly, is a private central bank in Sweden. And actually it preceded the Bank of England by nearly 30 years. It was created in 1668 and is still a private central bank in Sweden today. And in 1968, the 300th anniversary of that bank, they created the so-called Economics Nobel Prize, which the wording of it really talks about honoring Alfred Nobel. But it is widely accepted in common terminology as the Nobel Prize in Economics. And Werner points out that of all the articles published by winners of that Nobel Prize, none of them acknowledges the creation of money out of nothing. It appears that the winners of the Nobel Prize in Economics are all adherents of these other theories that are not correct, that lead to improper regulation and really serve the interests of the private banks, which is not surprising, perhaps, considering that the Reichsbank is a private central bank. Clarity on this issue is what we hope will come out of education on public banking. That summarizes my my presentation, and let's open it to questions.
Oh, do you want to do away with the screen?
Yeah, let me stop the share. Good idea. All right.
If you've got questions, you can unmute yourself and go ahead.
Can I raise a question, actually, that I've been reflecting on while you've been talking? And I don't know whether how these questions might come across to everyone. But when money is created, how can it be created? How can it be cancelled or reversed? I mean, basically, I mean, I've got savings in my bank account, which I don't use because they're savings for a rainy day, as it were. But they're there and they can be brought into use whenever I feel the wish to do so. And when I bring them into use, I can go and buy whatever they can be exchanged for. I find this quite an interesting starting point, really. And it seems to suggest another thing, that banks lend currency which can be exchanged for other people's assets, basically, so they can create money for real assets, but the money they create is not a real asset. I just think there are two interesting questions there that I'll have to reflect upon to stir my mind up a bit about them, because I think it's quite important that this money out of nothing has a great power in the community, because people can't recognize it for anything else but something they can get in exchange for something. But it's not a real asset. It hasn't been earned. It's not real, but it has the power of taking the real. Does that make sense, any of that?
Well, yes. Once someone takes out a loan, even though it's a so-called fictitious deposit, as Werner describes it, it becomes money. It becomes real money. It's accepted in the economy as new money, and you can purchase things with it.
But the point I'm making is that it itself is not a real asset. It's a sleight of hand trick, as it were. You've not created a real asset, and in like barter, I give you something I made, something that's real for something that you've made, or which is also real. But money is one of those things which it's not real, really, but it can be seen to be real and believed, and therefore it's a dangerous commodity. I suspect.
So Michael, are you using the word asset? You use two words. One is that it is a good in and of itself, has physical reality, as it were. And the other thing that you said was that it's been earned.
Yeah, well, I mean,
right? That you associate asset with something that's been earned, whereas
something that's been created.
money,
I mean, it's work on land, as we all seem to believe. Work on land produces something that's useful. You know, it takes raw materials and changes into something, and it becomes useful.
I'm just asking a question as to how you differentiate asset from money when you say that money is not an asset.
Well, that's the point I'm trying to make. It seems to me that money itself is not really an asset unless it can be traced back to something that was a real asset, and that it works by substitution. You've given up something and you've changed it into something else, which you then use. I know it sounds very convoluting, but I think that's what money seems to brings out in conversation, doesn't it? You sometimes you see something and it doesn't seem real, and it's well, the literature's full of these things. You know, what's it? One of the great economists said. Well, I can't remember the quote now, but you know, it's a phenomenon that's almost obscene, really. That you can create something that's not useful, but it can buy something that is useful, and you can create that something ad infinitum. I mean, modern money theory suggests you can pour money into the community, but it's only when it can keep alive people's activities so that they can actually work and produce goods and services which are useful. But of itself, it's it does nothing. It's a complete three-card trick.
Well, as
So,
Alec pointed out, one of the definitions of money is a medium of exchange.
Yeah, I understand that.
And if the money is trusted as a medium of exchange, people will accept it, even though it's worthless by itself. A piece of paper that has no value in itself. But as long as you can use it and people will accept it in trade to purchase anything, it has the value that it's face value in effect. And that's why we kind of, for practical reasons, prefer the definition of money as a medium of exchange. But what our public banking approach shows is that it's extremely important, because money is capable of being created out of nothing. It's extremely important who controls it. If it is controlled by the public interest, for the public interest by the public, you can do things that correct the problems and distortions that are created when private banks control money, that leads repeatedly to bubbles and recessions. For example, one of the things that can be done if the money is publicly controlled is you can say, we are going to limit or prohibit the creation of money to purchase existing assets, such as stocks and real estate. Those were the things that created the Great Depression with stocks and the Great Recession with real estate, respectively. If a public bank is told, and your laws say you may not use it for that, then you eliminate that enormous source of bubbles, or at least you greatly reduce it. There are other things you can do to reduce bubbles. For example, what we mentioned last time, one of which is not to pay commissions or allow the payment of commissions to real estate brokers for making loans to purchase real estate or other loans. Another thing that can be done is to limit loans for the purchase of consumer goods. That may not create the same bubbles, but that can create inflation, because you're not creating new goods and services, but you are pumping more money into the economy.
yes.
That might have some benefits to equalize purchasing power by parts of the population. But the most important and valuable method of making loans is to have them being used for the creation of new goods and services, for productive purposes, in other words. That is not inflationary, because you're creating new money to produce goods that constitute the supply that matches the demand represented by the new money. And this is, for example, what the Bank of North Dakota does to a substantial degree, and the German Sparkassen with their, banks in many hundreds of cities and with 1,500 branches, where a very large portion of their lending is to produce new goods and services. And as we mentioned, that's really the backbone of their economy, and why it's the strongest economy in Europe, and why they've not had bank failures for 200 years.
Well, I acknowledge the fact that money can, because it can be believed, can create the illusion that it's worth what it is. It's an encouragement to goods and services, but it's only the goods and it's only the free. All it does is create the freedom for the goods and services to be created.
Yeah, yes, Michael.
Looks that way, doesn't it?
Essentially, what is being said here is that money is valuable not in and of itself, but instrumentally so. That is to say, if we didn't have money and money created in the proper way, that is to say, for the common good, then we would be lacking that common good that money was instrumental in producing. So let's see if Joe, Bon Giovanni, please.
So thank you. I wanted to get to Michael's question, which in the beginning, which was about asset versus money and what they
Yes.
are.
Yes.
And but first, I want to say to Michael, you get a large degree of support and encouragement if you read the Credit River decision, which was a lawsuit brought by a borrower against its bank and the Federal Reserve Bank of Minneapolis, I think back in like 1960 or something like that, in which this question came up. You know, like the bank didn't really bring anything to any consideration to the transaction. So please try to look that up, and you'll find a lot of support there for the way that you're thinking. The second thing I want to say is that okay, so I'm sorry, but I'm going to make another suggestion about reading. Federal Reserve Bank of Chicago, starting in the 1960s, published a book called Modern Money Mechanics.
Yes.
And in that book, it states very clearly that the money supply is created by the banks.
Yes.
And my dad, gave me that book in the 60s as he was trying to teach me about money. And so to me, the big surprise to me is that it's a surprise
Yes.
to anyone that the banks create the money. The Fed has been telling everybody that would read their publication that the banks create the money. So that's just kind of one of those mysteries. Then the last thing about the money and the assets, okay? And creating money out of nothing. It's a valid statement, and although partly euphemism, but in fact, what happens is the bank never creates the money and never creates the deposit until it has in its vault a loan agreement with a promissory note attached to it to repay the money. And that is the asset that the bank has against which to issue the deposit that goes into the borrower's account. So it is sort of asset backed, but it's the coercion of the bank to be able to get somebody to say, if you sign this and agree to pay this back, then I'll lend you the money. And to me, the deeper irony in the whole thing is that in addition to signing the promissory note, that the borrower has to put up collateral in order to get the loan. So that is when you take the whole picture, when you talk about public purpose and public benefit, et cetera, that the whole thing goes kind of crazy. The banks get a promissory note, which is a capital asset, okay, something that's tradable, something in which that for the rest of their lives they'll be able to get a return from, interest payment from, and at the same time they get to hold the collateral provided by the borrower, which has to be a free asset, has to be something that's unencumbered, and so they get to hold all that stuff and then rule the capital development of the economy. And I'm going to shut up right there. Thank you.
Yeah, that's a good point, Joe.
Great points, Joe.
Yeah, Joe, very good. So one of the clarifications that you made is that for something to be an asset, it doesn't have to be a physical thing.
Right.
And that answers part of the question of Michael's, because he seems to associate asset with something physical.
Okay.
That's my understanding.
I didn't quite get to that
so
point.
That's very, very useful contribution there. Thank you.
Thank you.
Yeah, I want to add just a little bit. Not only does the bank create new money when it makes a loan, and Joe, you made a good point that they're actually purchasing a contract, a promissory note.
Right.
But they also create money when they purchase an investment,
Right.
which is somewhat the same thing. You purchase an investment, you're purchasing a contract. So it's not just when they make direct loans that they create new money, but also when they purchase investments. And some of the big Wall Street banks mostly are purchasing investments. They're not making loans with a large portion of their money creation, which is one of the reasons they're not contributing to a productive economy.
Exactly.
Yeah.
Totally.
And an interesting example that I heard Ellen Brown present at a conference in Philadelphia of public banking is a scene after the horrible hurricane in 2005. And New Orleans is in shatters. And an alien is visiting, and he's offering to help out. And the mayor and the governor of Louisiana and New Orleans are there, and he asks him, "Well, why haven't you fixed things up?" And the mayor says, "Well, the alien says, well, don't you have the physical materials?" "Oh yeah, we've got the physical materials." What about the people? Don't you have the people to do the work?" "Oh yeah, we've got that." "Well, then what's the problem?" "Well, we don't have these little green things we call money." And the alien says, "Well, beam me up, Scotty. No intelligent life here."
Yeah.
And the point is that we can create money. Banks and governments can create money. It just has to be done responsibly, and it can be, which is why we believe so strongly in public banking, which has been demonstrated to be a very responsible way to do it. How about, I saw another question there from Ray Schmitz.
Hi, Earl, thank you. So my question, it relates to the War Finance Corporation between World War I and II, and then the Reconstruction Finance Corporation that Hoover proposed and FDR used significantly during the Depression.
Yes.
Were these not, in fact, essentially public banks operated by the US government? They created their own finance. And I guess the second part of that question is, if that's the right characterization, like, how was it so easily obfuscated what's actually happening with private banks creating credit when we had two occasions of a multi-year period where a public institution was creating credit and then it went away? I don't really even understand how that happened without sort of an uproar. Do you know enough about the history to comment on this?
I know enough to comment on it. Ellen Brown has a very good chapter on that in the Public Banking Solution. It was founded under Hoover, but he did not use it to put money into the real economy. He used it only to put money into the banks, and they were not in a position to put that money into the real economy. Under Roosevelt, who had a background in banking, he used that to actually put money into the real economy. And it produced roughly $35 billion that played a very significant role in helping us out of the Depression. And it also helped a lot with funding World War II. But after that, it was allowed to taper off and was eventually closed in 1957. And I think, and this has been true of public banks generally, the general public does not understand enough about banking, and the same is true of politicians and others, to realize that you've got something of an asset here that can establish a very strong and stable economy, but you've got to understand it and you've got to preserve it. It's like that quote about how eternal vigilance is the price of liberty. If you want to have public banking, it's going to take eternal vigilance. The big banks do know what's going on. The general public does not, and most bankers don't. And unless the public is widely educated in this and motivated to keep these things going, these banks have been closed after a period of time. And one other comment about the Reconstruction Finance Corporation. It acted more as a banker's bank, as I understand it, than making loans directly to individuals. Anyone else have a comment on that?
Well, I can comment somewhat, as again, some of you know, I spent 50 years in economic departments. I got a bachelor's, master's, and a PhD in economics. And I must tell you that it's only when I left the university, or close to leaving the university, that I understood how faulty the thinking was of the economic textbooks that I was teaching from. So it's a matter not only of the education of the general public, but also of educators who perpetuate a particular way of looking at economics. The same thing holds for land value tax. I mean, a lot of really very, very important ideas are not brought in to the academy. Yes, Joe.
I have a question too, sorry.
Oh, yes.
Okay, so getting back to the interesting dichotomy that Earl mentioned between the two types of lending. Lending for consumption, which by definition is inflationary. That's also according to Werner's typology. And
Yes.
lending for production, which basically add more goods and services,
Yes.
and therefore is not inflationary.
Yes.
So
Yes.
the point here I'm going to say, because in the public banking model that you have presented, the role of creating money would be something that belongs to the public, which to me makes sense, because as the discussion just showed, money exists because of the trust of the community, and money creation also gives privilege. It gives prohibitive powers. So those, if it is gives a privilege, then it's better to have it out of the hands of private entities and given to public entities that work for everybody. But in any case, in the model that you presented, the lending part is going to be done by banks. Basically, the market will be allocating the direction of the credit. Where is money going to be lent? The government is going to do that. If the private banks are doing the lending, is the government going to tell them where to lend the money? Like
the public bank that is owned by the local government, let's say city or state.
Yeah.
But the lending is decided by bankers who are not looking out for the interest of private individuals, because the bank is owned by the government, and therefore there is a responsibility on the part of the head of the bank to make loans that are good for the common good and not from private profit.
But
That's
but
the
in,
whole thing.
in the model that you presented, so there will be no private banking at all?
We haven't
No.
made a decision about that, actually. We're
Okay.
saying that we need to have public banks.
Okay, well, I understood it from the point of view of splitting the roles between money creation and the day-to-day money lending. Because
No,
I've
no,
seen,
no.
for example, the case of Japan, where they used to have, that's before what they call the Big Bang in Japan, the big banking reform, where they basically adopted the Bretton Woods ideas. But before that, they used to have something called credit guidance. The private banks still existed. They were doing the lending, but the central bank was just basically issuing guidelines. For example, don't lend to real estate, don't lend to people for consumption, but instead lend to, for example, building steel mills, car factories, anything that is in line with the government priorities.
Yeah.
So there was
That's a
Yeah.
very good point. And
Yeah.
Richard Werner makes that point.
Exactly.
The bank does not make the actual lending decisions, but it establishes guidelines, or
exactly.
they can be established in the law that we're not going to allow a public bank to, or the banks that are funded by them, to invest in real estate or other fixed assets like stocks.
Exactly.
Or consumer goods. We're going to focus at least the large majority of our lending on producing new goods and services. And you can also establish guidelines for sustainability, environmental issues.
Yes, but
And yeah,
what we're proposing, however, is not to have a central bank suggest to private banks where they ought to loan and where they ought not to loan. What we're proposing is to have public banks that are owned by the local governments, where the tax revenue and fees are deposited in such a public bank, and that public bank then makes loans on the basis of its own capital for the common good.
Okay. Basically having a public option. Private banks would be doing it according to what they think the market rewards best.
Yes,
Public option would be there just to make sure the public lending is directed towards what we as a society consider as something important.
yeah, and we'll be guided by the charter of the public bank,
Yeah.
and also a board to see to it that the charter is followed.
Okay.
Yeah.
Thanks.
yes. And Richard Werner emphasizes that lending decisions should be made locally by bankers who are focused on responsible lending for purposes that serve the public interest, but the decisions are made locally. So it's decentralized. Each actual loan is made by lenders that know the local community, they know the borrowers, they examine their credit carefully so that they have a very safe lending record. And that's true of public banks. They have a lower default rate than private banks in general. Even China, which has more public banks percentage-wise as a total of its total banking assets, has done something that Werner comments on, that they have decentralized a great deal of their lending, going back 40 years or so. And it's been a principal reason why they have grown so fast, that they have had localized lending for production of new goods and services. If you do that, your economy can grow very fast. And of course, their economy is about to overtake ours. And it's, if you look at a situation like the Ukraine, Russia and China have more public bank focused lending, and they are trying to help South Asia, the Middle East, and maybe Africa and South America. They're in a better position to do that because of their public bank focus. The United States led by the big private banks is not performing that function in as good a fashion. And I think it's one of the reasons why the interests that are, influencing our government the most are focusing on military efforts and against China and Russia. It's not good for the United States having our economy dominated by these major private banks and the interests that they prefer to fund. And I think it
So,
endangers world peace.
Joe, do you have another comment? You had your hand up?
Uh, First, a quick anecdote, which is because Werner raised, the issue of the fact that 90% of the bankers don't know where the money comes from. Okay, which should on its surface seem outrageous. Okay, but I have found it to be way more than true. But my dad, in trying to get me to be interested in the monetary system, made this statement to me, which I was sure was also wrong. He said 90% of the bankers and 95% of the economists and 99% of the people in Congress don't know who creates the money or where the money comes from. Now, at the time, 99% seemed like a lot, but I'm sure that right now it has to be 99.9% because I can't imagine that there's a person in the Congress that really knows where money comes from. So, but having said that, yeah, I'm just going to leave it at that. I'm just going to leave it at that because ultimately, the monetary system is not taught in any college or university in this country. It ought to be taught right here at the Henry George School. That's where it really ought to be taught, because Henry George was a person who had a perfect understanding of the wealth issues and the income issues and all of that. But there's no college or university in the country that has a course on the monetary system, and I don't know how many people are familiar with. But Paul Krugman, the story is told by the German economist, who was about local currencies. And he said that when Paul Krugman got to Princeton and they signed him an advisor, and he went in and he told them, I want to study the monetary system. And the response was that, well, you can study the monetary system here, but we'll have to come up with the coursework. or you can study monetary economics as is taught. And maybe go on to write, 1,000 papers on the topic and get employed by a university and maybe win a Nobel Prize. So given that one of the ways was going to pay his way, one of the either studying the monetary system, what he wanted to do, there was, to me, that was a good thing. The fact that he was looking at everything that was going on and he realized the monetary system was under taught. But on the other hand, they told him, no, we don't teach that here. And the fact is, it's not taught in any, we teach money in banking. We teach a lot of different things. We even, in terms of monetary economy, but we don't teach the monetary system. And until we teach the monetary system, we're going to have all these questions that have to do with what the banks do, the banking, what does the government do, the money, how, and all of those things are going to remain the mystery until it's taught actually,
Well,
again, somewhere.
well, Joe, this is what Earl and I are attempting to do anyway.
Yes.
No, really, without having, an economics department or what have you. And so we're trying out our wings and also telling you what we have done in the process and what remains to be done, because we still don't have one public bank in Colorado.
Yeah, I think we should start teaching this in junior high schools and high schools.
Right,
and
exactly.
right up through college. And maybe they'll put pressure on the universities. Hey, you got to start teaching this
But
stuff.
not necessarily in an economics department, but as
No.
general knowledge.
Yeah.
Political economy and civics have gone,
Yeah.
by the wayside, and it's a very unfortunate, outcome that paves the way for the ignorance that we have of the monetary system. Both of those.
Okay,
Yeah.
let's have somebody else. Any more questions or comments?
Michael
love
has a
comments.
question.
Who does?
Michael, you're muted. You need to unmute yourself.
Michael, who Michael?
Michael iPhone.
Hey there, how's that? I just unmuted.
Very
Okay,
good.
so thank you very much, and I'm glad you're discussing this topic because I lived in Germany for a couple of years, but I didn't realize until after I'd left how great that public banking system was. And what happened is, just as Earl said, they are catering only to the community. Each bank there is chartered, each Sparkasse bank in every city is chartered only to loan money into the community.
Yes.
So to benefit that community. So any loan, any money that's made after that goes back into the public account.
Yes.
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 In other words, it doesn't go through Wall Street where someone's gambling on some other investment, and then they're extracting the money that they make out of it and then pass it on to the account for loaning the money into the bank. But now what happened also, the Sparkasses mainly are building things or getting construction done for like libraries, hospitals, public institutions that will bring more benefit to the local area. And they are forbidden by law to give loans to anyone outside of their area.
Yes.
They have a certain area, and they are forbidden by law, by the charter. No one can come say, you can't have a cousin that's down and out and decides to move, decides to come down to get a loan from you in the bank when you're 500 miles away. It won't happen. It only can happen in the community. And one of the first ways they started, believe it or not, was, I think, after 30 years war, the Swedish soldiers, or Sweden, the country of Sweden, they had a huge army during that war, and what happened? A huge military presence in that war. They came down from Sweden to fight in the mainland Europe. That whole war was fought on German soil, practically, from mercenaries coming from foreign areas. But what happened? Sweden, actually, the country of Sweden, gave a remittance to Germany for the damage caused in the previous war when they've had there. And that was put aside for a long time, and it all went into building a construction bank. In other words, and it was used mainly to build in Rhineland, that area, Rhineland-Pfalz. And it was tremendously successful that they used that as a model later for another bank just like it. And it became a model for development banks in Germany.
That's interesting. By the way, Germany has a national public development bank called KfW that is also a very helpful public bank.
Yeah,
and it's basically an infrastructure bank.
Well, that's exactly how it started that way, from that war remittance. They didn't even ask for it; it was given to them by Sweden. So it just goes to show you the Swedes have always had a sort of even-keeled look. They had a great look, a great vision in Europe to be stable and to promote business that way. To do that, they were the first ones to do something like that.
Yeah. So, who was that speaking? Sorry.
Michael.
Michael.
Actually, I did some lectures on public banking there a few years ago at Henry George, and I was very familiar. Also, the other thing, if you don't mind me saying, is that this accounts for that the huge development of Mittelstand, that middle-sized enterprises, medium-sized, small to medium-sized enterprises in Germany, because they loan things to the local people to start businesses. Lots of these guys were tinkers. You know, Germany was a divided empire for a long time. They never really got together. They got together very late, 1870, 1871. And it was always natural for them to trade outside of their area. And what happened is they developed huge businesses after World War II. This is what Werner Erhard
Yeah.
brought along, and it was why you had this called the Wirtschaftswunder, the economic wonder. That's why that happened, because all of these people, that farming was going by the wayside then, but they had this incredible ability to be tinkerers and develop, you know, when they needed machine parts for a mill, where the parts were hundreds of years old and were made by hand anyways, they had to make things to replace them. An uncle of mine, it actually has a mill and used to have it in Birmingham, Pennsylvania. And those parts in there were from turn of the century, 1900s. And he was always able to fix it and make a new part to keep the mill running the whole time. And it was always a source of amazement to me that he could do that. Well, thank you.
Yes.
You're welcome.
Just a very brief comment to you, Michael, that we have on our board a fellow who's our tech guy, but who's also always nipping at our heels, saying to whatever we say in our board meetings or elsewhere, he says, are we sure that it functions for the region and not from some other interest? So we're kept in good discipline by another member of our board.
Yes, and we did our draft legislation. We have put in it that the public banks shall make loans based on this regional principle, that you only lend in your own community and area. And that's very useful for establishing sound loans.
So can I add one more thing?
Yes.
Yes, please.
Yeah, so, you know, in German, the word for debt, it's Schuld. And it's also the word for guilt. And so the Germans have this sense of not being, not borrowing money, you know, and if they should default on a loan, you know, they feel a sense of shame. So they're very much like that. I mean, imagine, you know, it goes back to the language. You know, the way the Germans always build a new word out of multiple other words, you know.
Yeah.
I was always amused that was, you know, for instance, like a sightseeing, you know, I'm going sightseeing, you know, so the thing that you would be sightseeing, it's a German word, sehen, to see, werdig, worth, kiten, thing, a seeing worthy thing.
Yes, Michael, you have another, Michael Leroy has a comment.
Just a bit of clarification, really, to both of you. You know, in England we have what we call building societies who just take deposits in real money, as I might suggest, and they can lend it out. So it's real assets being lent out. Do these public banks have this same facility, but they also have the power to create money out of thin air?
No.
You know, and that adds to their quantity of money that they issue.
I think.
Could you restate that, Michael?
Yeah,
You know,
I think I can answer that. What he's asking is that, do the public banks in Germany like that, do they have the ability to make money out of thin air? No, the Germans are prolific savers. So they have saved a lot of money and deposited in there.
Yeah.
In it. And even I remember when I was living in Mannheim, I was just working there for a couple of years. I had a contract in the opera house, and I was a dancer at the time. So what happened, even I would go into the Sparkasse, and then all of a sudden they would ask me, yes, come here, sit with us. We haven't seen you before. Are you new? What are you doing here? Is there anything we can do to help you? And then I never quite understood at that point what it meant. But later I did when I understood what the public banking system. In other words, they're looking for ways always to build up the community. And they're doing it basically through loans. As far as making money like that, what the Sparkasses do, a lot of them, they used to have a model where they would give some of their savings to the Landesbanks. These are the larger departmental banks. They're like for a
Right.
region. And those Landesbanks were the ones that knew how to invest. But unfortunately, there were two of them that got into trouble in 2008 because they were investing in these funds in America that went belly up.
That's right.
But-
I want to
but-
comment about your point about savings in Germany. One of the reasons we don't have much saving in this country is that by having 97% of our money created by private banks, we have this constant siphon of money from ordinary people in the middle class to the bankers and other wealthy people. And because 97% of our money is created as debt, savings are almost impossible for ordinary people. I think the average amount of debt of a citizen in the United States is something like $55,000. With public banks dominating or at least covering a large part of your economy, the income can be put to productive use that reduces debt, that creates wealth, that provides free recreational and other services for the public, and reduces the amount of debt and increases the amount of savings by the public in general.
Also, one thing, Germany, they don't allow land speculation as much there as in other countries as well. They managed to put a cap on that.
That's
You know,
good.
because they want to be sure that all of the, 60 to 67% of the Germans at one point, around 2000, 2005, when they had the Mittelstand was doing gangbusters, mainly because of China buying a lot of their products. And what happened is that they always make sure that there's enough housing there for the workers and for the middle class, so that they don't ever get in a situation where they have like a landlord over them that kicks them out, things like that. So they make sure that they keep the speculation down on land and rents like that.
Michael,
good.
we have another question from James Fredrickson. Yes, Yanni.
Thank you very much. This question is actually for Mr. Michael iPhone, who was just talking, and I find it intriguing that within 3 minutes of my putting my hand up, he answered my question, not my having asked it. Two German nationals whom I happen to meet and with whom I happen to speak during the last 5 years have told me that the law in Germany says that if you buy a piece of land and sell it within 10 years at a higher price than you purchased it, all of the excess money goes to the government. Is that your understanding, Michael iPhone?
Well, I didn't actually know the details. See, you knew the detail, and I just understood the outcome. They keep a cap. They don't allow excessive land speculation.
I appreciate your comments. I'm not sure that what I told you is exactly correct because it was learned during informal conversations. But one of them was with a German legislator who had attended the National Association of State Legislatures in the United States as a visiting guest. And the other was a laboratory investigator, a colleague of mine, with whom I worked between roughly 12 years ago and 10 years ago. Thank you very much.
Well,
So
you know,
we have only
Yeah,
5 minutes to go, so maybe we should have somebody else ask a question or what we really like our comments. Anybody else?
I'll mention a little story. I talked to, this confirms what we said and what one of our attendees said about how bankers don't know how banks create money. Many of them don't. I met the president of a bank with about $200 million in loans out, which is considered a community bank. Very public interest oriented bank. They wouldn't lend for fracking, for example. But he did not know that banks create new money when they make loans. And partly as a result of that, he was against public banks. But this is, again, emphasizing the vast need for educating the public at all levels and ages on banking and finance and how money is created.
And also members of Congress and members of the Senate. When we were presenting something to one of the representatives here in Colorado, and I very lightly, very carefully suggested that banks can create money without mentioning out of thin air, which seems to be a red flag for many people. He was really outraged. He didn't altogether leave the meeting, but he was outraged as if this was something really altogether out of nowhere.
Yeah, he called it, you're creating something out of whole cloth, meaning basically
yes, that's
it's
right.
a fraud. Yeah.
Yes, yes. Just the mention of it, let alone actually doing it.
Yes, but he did leave the legislature just recently. He had some personal problems. So I don't know, maybe there's a little karma there.
And before we go, can I just mention again the Credit River decision about this, which is really kind of the definitive legal undertaking to consider what happens in a transaction when somebody makes a loan, when somebody borrows money and takes out a loan. And it's really telling. It clears it up for sure. And basically, the judge in that case, just to ruin the whole mystery, he found in favor of the plaintiff that the banks cannot collect on the loan that they made because they did not bring any consideration to the table. So therefore, that's actually, that decision still stands today.
And what year was that?
If you just Google the Credit River decision and the Minneapolis Federal Reserve Bank of Minneapolis, you'll find it. I think it was like in the very early 60s. That's what I'm pretty sure, but I'm not positive of that.
I think you're right. It's also written up in some detail in Ellen Brown's either Web of Debt or the Public Bank Solution.
Okay.
Yeah, but
Okay,
we're getting short. I see.
I know.
Yanis has a question.
Yeah, Yanis has a question or comment. Yanis.
Yes, I have a comment. I don't think it's too much of a conspiracy. I think it's kind of like, common sense that when a bank makes loan, the person who gets loaned the money does actually something productive out of it. So it's natural that when a bank makes loans, it creates economic activity, and then it collects on that activity. So I don't think I don't think it's either conspiratorial nor you know
Accusative?
obscure that when you make a loan to somebody and you put him to work, that this creates an economic output. Now, the contrarian question to that, to the criticism of banks making loans and thus creating money, which we think it's kind of like surreptitious, nefarious and everything, is that if the banks did not make these loans,
Yes.
okay, most of them at leverage ratios, we would have a much more subdued economy with much less economic product and services and innovation. So,
Yeah,
so I want to understand, what is this? Is this a criticism? Because you make it sound like as if, oh, there is some like hidden magic that we don't know about and banks are doing something nefarious. And I'm trying to understand, where is this criticisms go?
We
That
take
banks
it up next
should-
week.
No. We were just saying essentially that that's the truth, that banks create money. Now, what is at issue is what that money is used for. Who benefits from that creation of money? Is it the community in general, or altogether private interests? That's the issue. It's the use or that the money is put to that has been created that is the issue. We
Goes
want the
back.
money to go to places that we want it to go, rather than places where private individuals want it to go. That doesn't mean that we don't say the private banks couldn't exist. What we're saying is that funds that come from the public, namely taxes and fees, should be used for the common good and not for private good, as is used by private banks.
So then we should forbid governments using private contractors, because that's where the tax money goes. And the private contractors, they know that, and then they jack up the prices. The governments do not have enough taxes to pay for the government spending, and then they borrow. So
Yes,
government. What I understand is government are the problem, not the banks.
Yeah, the thing, Yanis, is that governments, of course, can be the problem, just as surely as private individuals can be the problem. That's why, because you can have bad governments, right? You can have governments that use the public funds for very, very bad purposes. So we're saying that the funds that are collected by governments, namely taxes and fees, should be put in an institution that uses those funds to do good for the public, since the money comes from the public, rather than for a private good. That doesn't mean that private banks couldn't exist.
Yeah, if I may make a small comment, that the taxes is a very, very small percentage of the government issuance of money. So I think we should focus more on the government borrowing, the government debt, and then
But we're talking only about state, not about the federal government. We're talking about state and municipal governments. That's what public banking is about. There is no suggestion that public banks should be ones for the federal government. That's a completely different discussion.
But state governments borrow as well. The state of Illinois was almost bankrupt.
Yes.
Can I respond?
Yes, sure.
Okay, so this is for Giannis, okay? So, because Giannis is kind of saying that, oh, you can't be criticizing the private banks just for creating the money because they expand the economy. Well, yeah, there's two things that the banks do. They create the money and they expand the economy. We need to separate those two. Now, who also believes this? I'm a monetary reformer, so it's easy for me to say that, okay? But if you read Dr. Milton Friedman's 1948 paper, a monetary and fiscal framework for economic stability, there you will find that none other than Milton Friedman is a monetary reformer. He advocated the government issuing the money. Why? because he said capitalism cannot work without a level playing field. And if any entity within the economy can create the money and lend it to everybody else, you have an inherently unlevel playing field. And then if you do that, we're going to end up with what we got now. So it is definitely a problem, and I'd be glad to have a conversation with you about it, Giannis.
Joe, could you share that article by Friedman? I would love to read that.
Oh, sure. I'll put it in the chat if I can get
Yanni,
it on here. I've
Yanni,
got a link.
this is a
And Alec,
conversation. Yeah,
we are already 5 minutes off, and
yes. I was just going to say to Yanni that this is something that we can continue talking about because we can't do it now.
very good. Thanks.
Okay, that's,
Okay.
yes, to be continued. That's right. Yakara.
Thank you, Ibrahima.
Thank
Thank
you.
you.